Good afternoon, everyone. As previously mentioned, the CARES Act contains a much-needed technical correction that changed the classification of qualified improvement property effective January 1, 2018. This correction treats qualified improvement property as 15-year property and thus allows taxpayers to apply 100% bonus depreciation, and also changes the alternative depreciation system, or ADS, recovery period from 40 years to 20 years. In this segment, we're going to discuss how to take advantage of this new law change using accounting method changes. This retroactive change to the classification of qualified improvement property is summarized as follows. The regular recovery period under the Tax Cuts and Jobs Act was 39 years. Now, under the CARES Act, it's 1 year. Electing out of the regular recovery period, we expect the IRS will allow an election to use 15-year depreciation in lieu of bonus. And for electing real property trades or businesses, which are those businesses that chose not to have the new business interest expense limitations apply, ADS depreciation will be changed from 40 years to 20 years. So following the CARES Act being signed into law, the depreciation method used to depreciate qualified improvement property on 2018 tax returns is now an impermissible or incorrect method of accounting. In order to obtain the tax savings associated with this law change, we need to change from an impermissible or incorrect method of accounting for depreciation for 2018 qualified improvements to a permissible or correct method of depreciating qualified improvement property. There are two ways to accomplish this. We can amend the 2018 tax return, as Sean was talking about before, or apply for an accounting method change in 2019. Let's see what these two alternatives look like. By amending the 2018 tax return, you would either change depreciation from 39 years to 1 year. You could elect out of bonus depreciation and change to 15 years. Or you could change your alternative depreciation system depreciation from 40 years to 20 years for electing real property trades or businesses. As an alternative, by changing our method of accounting, we would accelerate the remaining 38 years of depreciation not taken in 2018 on the 2019 tax return, thereby claiming the missed depreciation as a favorable adjustment. Or you could deduct the 2018 difference between 39 years and 15-year depreciation on the 2019 tax return and depreciate the remaining cost basis over the next 14 years. Or you can deduct the 2018 difference between 40 and 20 years on the 2019 tax return and depreciate the remaining cost basis over 20 years beginning in the 2019 tax year. So how do we determine the best year, the best method for taking this additional depreciation? Should we amend our 2018 tax return, change our method of accounting in 19, or perhaps continue to use an incorrect method of accounting and change to a correct method in 2020 or some future year? This decision can depend on a number of different factors, including your immediate cash needs. As Sean mentioned before, you might have different partners in 2018 than you would have in a future year. Prior, current, and future years' taxable income, the impact on your net operating losses, the business interest expense limitation. There are a whole host of various international provisions that we're not going to cover today. Or it can just be a matter of not wanting to amend your prior year returns simply because there are multiple levels of partnership tax returns affected by this change, with a significant number of individuals that file in multiple states, and amending tax returns would be overly burdensome or too costly. Similar to what we experienced with recent tax reform, modeling of all of these and other CARES Act changes will be critical. So let's talk about some basic concepts in accounting method changes. What is an accounting method? Well, accounting method is a set of rules that determines the time, meaning tax periods, for reporting income and expenses. When you think of accounting methods, I think of cash versus accrual, the method of depreciation, and so on. Classifying the treatment of an item as an accounting method means that if a mistake was made in a prior year barred by the 3-year statute of limitations, let's say no depreciation was taken on an asset for the last 5 years, can likely correct that mistake in the current year by changing my method of accounting. What are changes in accounting method and why are they so important? Well, changes in accounting methods usually involve changing from an incorrect method to a correct method, or from one correct method to another correct method. Changes in accounting methods are important for a variety of reasons, including they can allow us to take deductions in the current year that were missed in prior years closed by the statute of limitations and can provide audit protection. Why does the IRS allow changes in accounting methods? Well, basically, it's really just to encourage compliance. Once a taxpayer adopts a method of accounting for an item, the taxpayer must obtain the consent of the IRS to change its method of accounting. There are two ways to accomplish this. First, by filing Form 3115 under the automatic change procedures, or by obtaining the advanced consent of the IRS. The instructions to Form 3115 currently show 239 automatic changes in accounting. So how do we make our change in accounting? Well, first and foremost, it's important to note that changing from an impermissible or incorrect method of tax depreciation to a permissible or correct method of tax depreciation is an automatic change in accounting. It happens to be designated change number 7. This change is made by preparing Form 3115 and attaching it to the filer's timely file tax return, including extensions. And you also need to file a duplicate copy with the service as provided for in the instructions. Next slide. Although authority exists for making this change in accounting, we spoke to the IRS National Office about making this change, and on an informal basis, they had the following to say. The IRS confirmed for us that designated change number 7 provides the way forward for making this automatic accounting method change. The service is considering all options that would serve to simplify this process. For example, having taxpayers take this deduction without having to file Form 3115, and perhaps eliminating some of the barriers for making this change contained in the revenue procedure. In prior years, when Congress had retroactively extended bonus depreciation, the IRS issued guidance that allowed taxpayers to do either or, pretty much the same that we're talking about today. The service plans on issuing procedural guidance this time around as well. So based on this history, it might be prudent to wait for procedural guidance before filing your change in accounting method. The change in accounting for depreciation is just one of the many ways to accelerate deductions to produce tax savings. As you proceed with the preparation of your 2019 tax returns, I would encourage you to explore additional opportunities to make accounting method changes. The following is my top 10 list of accounting method changes that might help to maximize tax savings this year.